The Biden administration has spent months spelling out the consequences of the U.S. defaulting on its debts.
An economic and financial catastrophe.
Millions of jobs lost, devastated retirement accounts, and a recession.
Lawmakers are deadlocked over raising U.S. borrowing limits, with the clock ticking towards the date when the government is in danger of running out of money to repay some of those debts and continue to function properly. But the Treasury Department says taxpayers are already paying the price.
We are seeing some stress in financial markets. Bill auctions for bills coming due around early to mid-June are trading at a significantly higher interest rates.
Those Treasury bills the government sells to finance itself form part of the $31.4 trillion public debt at the center of arguments over raising borrowing limits. Higher interest rates simply add to the debt, and the US has been here before. One study conducted after the US came close to defaulting on its debt back in 2011 found that taxpayers were saddled with nearly $19 billion in higher interest payments over the course of a decade as a result of the impact on borrowing costs. That figure may be a drop in the ocean of the overall debt, but it would go some way to paying for what are called discretionary programs for things like the environment, science, and community development, whose budgets lawmakers are arguing over. And if taxpayers and the government are losing out, some investors are winning.
We're seeing spreads widen and interest rates higher. We are seeing pockets of opportunities in markets. So as a whole, we are buying into this increased volatility.
And yet that kind of volatility might be too much to handle if the US can't resolve this debt crisis. Owen Fairclough, CGTN, Washington.